Hey everybody, Preston Brent here with our free weekly roundup for the trading week ending April 27th, 2018, brought to you by our trader user group. Hey, really interesting week, a little bit of a whipsaw, but we didn't really kind of go much anywhere. The S&Ps really finished flat for the week. The Dow was down just a little bit, about 62 basis points. That's 0.6%. NASDAQ was down about 37 basis points. The Vix averaged about 16.77 for the week, and we did see a little bit of excitement in the Treasury yields moving over 3%, only to pull back and finish the week at about 9.6, 2.96%, slightly under the 3% level. I still think the markets are about the three T's, or maybe they've become the four T's. That would be the tariffs, technology tightening, um, and the Trump tweets. That's kind of what I'm looking at in the market. But if we look at kind of where we're sitting right now, we've had most market investors, big money, very critical of this Q1 earnings results. Just take a look at Caterpillar for an example. They came out and they beat expectations handedly. Yet when the CFO said during their earnings call that they may have hit peak earnings for the year, their stock immediately reversed from moving up higher and open, finished down about 6.2%. Although we did see some very strong earnings out of some of the tech with Facebook and Amazon, and we got a reawakening in the Chipotle stock play. But outside of that, we've seen so far about 50% of the S&P companies reporting earnings, and the beat rate, guys, is about 80%. I mean, it is the historical average, by the way, is 64%. And it looks like these beats are driving Q1 earnings per share growth to Q1 year over year at 25%. Unbelievable. Now we'll see where we finish off, but remember the analyst came in at the beginning of January saying Q1 earnings per share growth would be 12%. So looks like a lot of this stimulus that the Trump administration put in is starting to come through. But remember, some of the stimulus didn't start until January and February this year. So holdover from last year, but really a very powerful start to the year. But what I find interesting is investors mostly have just kind of given a big collective yawn to this huge Q1 earnings. Normally we would be up dramatically with this. But the S&P, since we kicked off earnings with JP Morgan and Citi and Wells Fargo on a Friday, I think back a few weeks ago, beginning of the year, the S&P is only up about 20 basis points, 0.2%. So why are we getting this disparity? I mean, there is a lot, as I said, of political risk out there. Some geopolitical, others generally like the tariffs or maybe withdrawn from Iran and some of those things. And some others are interest rate related, the tightening, one of the T's that relates to tightening. Now we get the Feds coming up this Tuesday and Wednesday, and on Wednesday we get their policy statement. Remember, they do not do a conference. They do that only on the quarter end. And no one's expecting them to hike the rates this Wednesday, but everybody wants to see them come out and see what is their tone and tenor for the remaining part of the year. Are there going to be 2 more rate hikes this year, giving us 3? Or are there going to be 3 more rate hikes this year, giving us 4 for the year? That's what everybody wants to know. So the markets are kind of in this pause mode until we get through that, with an overlay of all the other things that we've got going on as potential risk in the markets. So there's about a 34% Fed fund futures probability of a rate hike this next Wednesday. But if we go out to June, which is a quarter in, that rate hike probability goes up to 93% in June. And that would bring our rates up to 1.75 to 2% range. And then there's another 76% probability of another rate hike in the September 25-26 FOMC meeting. And then it's about even money, 50-50 on whether we do a rate hike at the end of the year, the last quarter of the year, middle of December. So that is where the markets want to play right now. Keep in mind, I've been telling my members and you guys that tune into our weekly roundup, that price action is all about 2 things and only 2 things: earnings per share and interest rates. And earnings per share are providing a little bit of a floor right now because we've had very strong earnings. In fact, they're projected to be very strong this year, both top line and bottom line numbers. But we're getting, just as an example, The 90-day T-bill is it's over 2%, or a 6-month T-bill is at 2%, and a 2-year Treasury note is 2.5%, which is almost on parity with the S&P average dividend yield. And remember, the 6-month or the 2-year are considered risk-free investments. So do you want to take an extra 1% for dividend stocks with the risk of the stock crashing? You get your dividend, but the stock goes down, or come in on a short-term T-bill or a 2-year note, something like that. So we're starting to see competition on the short end of the duration curve for government debt versus equities, and that's going to continue as we go through the year. Q1, as I said, I think a few weeks ago, was a rare quarter where we had equities finish lower and we had bonds finish lower at the same time. Normally, bonds have been a nice hedge for equities. Generally, when equities go down, bonds go up. Money seeks safe haven. But we didn't see that in Q1, and it's a rare event. But when you get it, it does show sometimes that cash is becoming more of an asset class, which means you can take your cash and park it in a 90-day T-bill or a 6-month T-bill and get up to 2% on it, just to kind of wait things out to see what the markets are wanting to do, right? So you get money coming out of equities and bonds, and that drives up interest rates. And meanwhile, we've got the inflation that we're all looking at here. Now, over this past week, with GDP coming in at a little over 2.3%, understand Q1, just because of the way the U.S. collects GDP data, Q1 is always a low quarter for GDP. So they're expecting Q2 GDP to come in north of 3.2%. So just understand that. But the inflation gauge that the feds pay a lot of attention to is the pace deflator, which is at 1.7%. And that's moving towards their 2% goal. So what are the feds going to do? I think they're going to be like Super Mario Draghi this past week and be dovish. I think they're going to stick to the language of 2 more rate hikes this year, 3 rather than 4. The market seemed to be pricing in a better than even odds that we're going to have 3 more rate hikes this year, which would give us 4. And remember, the higher the interest rates go, the more competition for money goes into the debt market. So let's kind of see where we're floating around here. So that's kind of where we're sitting. Now, what I've got on the screen here is the daily chart of the S&P 500 futures. We'll look at this and we'll look at the SPX. I just wanted to show you something. Notice here on Friday or Thursday, we actually moved into the green for the year. And then on Friday, we just could not get up above it. So you can see the 2018 open price, and you can see where, we just held up there. And you can see also on earlier in the week, on Tuesday, and even on Monday, we were trying to get up above, and we just cannot. So this is a bogey for us. It's a psychological number more than anything else. It's a headline number for what I call the rat brain business journal of the day, which would be the National Enquirer or the Color by Numbers USA Today, right? Generally, when the markets go into the green for the year, you see a big headline print. Markets in the green for the year, then everybody rushes to buy, or markets in the red for the year, and everybody rushes to sell. So it's a psychological barrier. I don't pay much more attention to it than that, but I always encourage our members to make sure that you mark your charts on everything that you trade with the high price for the year, the low price for the year, and the open price for the year, because market prices always seem to come back and sit on that number. Okay, and it attracts it like bugs to a bug zapper. And that's kind of where we're sitting right now, right on that price. Okay, and you can see all this volume over price right here, which is why this zone is shaded as it's shaded. So we've got what I call our S1 support right here. Okay, and you can also see in this, well, maybe you can't. Let me get all these drawings off the screen here. But you can see there's the 50 EMA. It started to slightly turn down with a downward vector. The 200 EMA has still got a slightly upward vector to it, okay? So we're sandwiched right between these two. And I've been telling our members that it's going to be kind of one of these markets until we can get some more clarity on the feds And then probably the bigger number is the tariffs. That would be the, I call them the three T's, tariffs and the Trump tweets, but they're all kind of interrelated, I guess. Um, if we come out of these tariffs where we do not do them and Trump is able to negotiate, or the administration is able to negotiate with China and the European Union, what he touts as a better deal for the U.S., then we're going to see market price action remove that as a risk premium into the markets. And that is going to be an immediate up move in the markets. Okay, immediate. And given the strong earnings that we have through the rest of the year, coupled with probably a dovish Fed, we're going to make new highs for the year. Okay. I don't see and given those parameters, we'll finish in the green for the year. Okay. That's the way I see it. I mean, the earnings they're going to drive that. I don't think interest rates are going to balloon too much higher than where they are here with a dovish Fed. Now, those are some big ifs. If the tariffs become more egregious, meaning Trump sticks to his guns and they can't negotiate anything, and we throw more tariffs, let's say in the semiconductor space for China, or we do the steel and aluminum tariffs for Europe. We gave them an interim reprieve, but we'll see what happens there. Or Trump pulls out of the Iran deal, and that creates more fear premium in oil that jacks up the price of oil, which will also jack up the apparent view of inflation. Then we're going to see the market sell off. So there's a lot of ifs here that no matter how clean a chart may look and no matter how good a technical pattern may show, you've got that risk that you've always got to maintain and manage to the downside. So this is the daily chart. Now, if I take everything off the screen, what I did on the daily chart is I put a fib node on here, and let me just move it out a little bit so that you can see. And this is the wide range that we've been in on the fib node, okay? And let's just back it out just a little bit so you can see a little bit more plainly here. When we look at the S&P 500 E-mini futures on a daily chart, all right, what's the definition of a trend, guys? Higher highs, higher lows, or lower highs and lower lows, okay? So what we've got here is we got a high, a lower high, and a lower high. And then we've got a low. It looked like we started to have a higher low there, right? And then we had that taken out. And now we've made another low here. So we've got this downsloping trend line, just like that, okay? And depending on whether I connect the dots like this, or I connect the dots like this. Either way, and that's the Andrews pitchfork, I just drew this stuff in. Either way, it shows that to clear this hurdle here, we've got to clear a number of different fear out in the market. One is, where is the Fed's going this year? And two, where are the tariffs going? Because those two things can impact this. If it looks like we get a dovish Fed and Trump can work the tariffs out and, things look good, we're going to clear this down sloping line. And then I'm going to look to take out this pivot point high up here. And we take this out, strong earnings will bring us back up to this area right here, and we'll make new all-time highs in the S&P 500 E-mini futures. Should that not happen, we're going to come down, we're going to test that 200 EMA, and we're going to work our way down and test this low level down here. Okay, so there are a lot of ifs, as you guys can tell, in the prognostication here. Let me just get that off the screen. There are a lot of ifs in this, but that's just why volatility's been elevated a little bit. And as I told our members, we're going to be in what I call the yellow zone with volatility for a little bit longer. You can see here the Vix average 16 point. As I said, the Vix average about 16.7 for the week. We finished the week with the Vix coming in at 15.41. But you can see here we're in the yellow, and I said we're going to average the yellow zone, which is based on what I've got indicated here, right around 15 all the way up to the low 20s. And these are just zones that you can start looking at different tactical plans for your overall portfolio based on where the volatility is, okay? But we're going to stay elevated here a lot longer than normal, just because when you have fear and you run up into the red or even to the black area, the black swan, which I call it over a VIX of 50, then it just tends to make the markets more sensitive to any down move. The market is more spooked, so volatility tends to spike. So for example, in 2017, when we had a rare 10 to 15 point down day, vol barely budged because it was low and the markets just said, okay, it's a buy the dip. And as you guys remember, in 2017, I was telling everybody to buy the dip all damn year long. This year, it's a little bit different, okay? Now when vol prices go down 15 points, 20 points, vol is going to go up because it's more sensitive to a down move this year than last year. So we're going to have that elevated move. So again, getting back to the E-minis and getting back, what I did here was I created this pivot range here. And that is where we're stuck. And I just put fibs nodes in here to help guide us on where are we and what are we doing. And you can see here that the open price is right almost sitting on the 0.23 fib node. Okay. So that's kind of where we're sitting right now. And I'm going to be watching this. So we're either going to break this or we're going to break this. And it's going to be dependent on those dependencies. The Fed's earnings are already coming in as a beat. So in many respects, earnings are providing a nice uplift to the market, right? So it's supporting the market to the upside. But we've got, pushing the market down, we have, as I said, those T's, Trump tweets, tariffs, possible Fed tightening. So that compresses the price into this area here. One of these is going to give it up. Either that downward pressure is going to go away or the upward pressure is going to go away. All right. And then we're going to have a breakout one way or the other. So until then, short-term strategies are best. Taking profits quickly are best. In our earnings trades, we've done some pre-earnings trades that have made money for us. We like those. Looking at possible interest rate plays, a little bit higher interest rate plays, I like those. And of course, we've been in the commodity markets and we've done well in commodities. Now we're still in oil and we're in the corn market as well. So these are working out well. So you can see where we are with a fib node here. Okay, and I just put everything back on the screen again. It kind of just drowns everything else out, but you can see kind of where we're sitting here. So where are we going from here? Well, next week we get Apple earnings. They're going to be coming out on Tuesday, so that's going to be a really good thing. And then we get on Wednesday the Fed at 2 p.m. Eastern Standard Time. We get their policy statement. And then one of my favorite companies, Ferrari, they come out with their earnings on Thursday. But we get BABA on Friday. Saturday, we get Warren Buffett's meeting, his Warren Berkshire Hathaway. They have their annual meeting, so everybody wants to hear the Oracle of Omaha come down and sit on his throne and speak. Be real interesting to see what his take is on the markets. But anyway, that's kind of where we're looking right now. Now, let's take a look at it from another perspective. Let's go over to the SPX. And then I'm going to put it on a weekly chart. This is the cash index. Okay. You can see this downsloping trend line right here. And you can see here, we pull back from the highs 11.82%. Okay. You can see the 2018 low. You can see the 2018 high. Let me just widen it out so maybe you can see a little bit better here. Okay. And then I put some fib nodes on here. But what I did with these fib nodes is obviously I captured the high point up here. Okay, so the high in the SPX was 2872.87. Okay, so I captured the high point. But if we come down here and look, where did I anchor the fib? I anchored it right here the day before, the night of the Trump election. Why did I do that? Because it was a complete policy shift in the U.S. government, a fiscal policy shift, complete. So when we look at that, and then we look at where are we, you can see the move lower here only moved down slightly. And we didn't, by the way, this is a weekly chart. We moved below the 38 percentile pullback, but we never did reach it to the 50 percentile level. Okay. And you can see where we're sitting right now on this. And we've got this downsloping trend line that I want to bust a move out of. And if we come back, but you can see these fib nodes. So we haven't even pulled back to 50%. So we've still got massive gains from the movement of excuse me, of the Trump fiscal policy here. Now, if we come into a daily chart, and really let's just zoom in on this thing here. Again, very similar. You can see the 50 EMA has got a slight downward vector, but only barely. But we're below the 2018 open price. We're above the 200 EMA. You can see the fib nodes here, okay, and the 0.6% node is sitting right at the 50 EMA, right at the 2018 open. So there's a lot of overhead resistance here to capture this downsloping trend line. Excuse me. So the markets want to they want to move higher, but it's in order to break free here and get outside of this, we need to get a little bit more clarity on the Fed. Damn. We got to get more clarity on the Feds. And I can draw this line like this. So at some point, we're going to come down, we're going to break one or the other, okay? And once we get clarity, we're going to see that. We're getting a little bit of a movement to the upside here, which is a good thing. So the markets seem to want to move higher. I mean, and the earnings are doing that. So assuming Trump stands out of the way, we don't have any more of the two T's, the Trump tweets, or the third T, the tariffs. And let's say they stand down or they negotiate something. I don't care what they come out with. Maybe as a consumer, I care, but from a financial perspective, I just want to know that they've got clarity in it because the markets hate ambiguity. Then we get a breakout, then we get a run. All right, so that's kind of where I'm spending my time right now. Now, we got a couple of things that I'm interested in from a stock perspective. Okay, these things I'm going to go through with our members this weekend. All right, if you're not a member of our group, I highly encourage you to come in. We've got our option masters. It's probably going to be, oh gosh, not probably, it will be hundreds of videos that we're running, and we're going to cover everything. I mean, everything. And our members are participating by giving me input as we go along. So if you're not in that, I highly encourage you to come in. And our secret trader with our trades, we got some really interesting trades that we're playing here. So this is a little bit about the markets and what I'm seeing here. If we come down and we look at the currency market, you can see here in the currency market where we had that breakout of the dollar. As I told you guys, and I've been saying this for a while now, we've had this huge long consolidation pattern in the dollar. And I was more prone here to get bullish. And that's what we, and I was suggesting either a bullish play in the US dollar index or a bearish play to neutral play in the euro. And you can see we're moving up to the 2018 open price, okay? We may have a little bit of a pullback here, but the dollar is showing upward momentum. That puts a little bit of a downward pressure on the commodity market, but this was something that I've been talking about for a while now. And then again, with the euro, if you can't play the dollar to the upside, the euro is more of an interesting play to the downside. So while the dollar is approaching the 2018 open price from the bottom up, the euro is approaching the 2018 open price from the top down. All right, because the euro maintains in the high 50 percentile of the value of the dollar index. It's one of the bigger rankings. So generally the dollar and the euro move in opposite directions. So you can see where we're sitting here on the euro. And Super Mario came out dovish this past week, so that would have a tendency to keep the euro in more of a range bound to slightly bearish mode here near term, with the dollar being just the opposite. Okay, now gold. Well, I'm still in a neutral bias on gold, to be honest. It's just, you can see I've got the 2016, 17, and 18 highs up here. These are over the past 3 years, and I left them on the chart just to show you just how much trouble gold is going to have getting up here. I don't think gold is going to break this until we move into a bear market. And by the way, I'm calling for a bear market not in 2018. In fact, I think we'll probably finish in the green this year, assuming Trump doesn't get in the way and the tariffs kind of stand down a little bit. I think we'll finish in the green. But I think in 2019, it's going to be a different story, and we're going to start the auspices of the beginning of a bear market. And then in 2020, it's going to be full tilt boogie to the downside. And I'm looking at anywhere from a 35 to a 50% pullback. Huge. But right now, I'm not looking at it that way. All right, but you can see gold, until we start to see more of that, gold's going to stay underneath the the tri-cycle gear up here of 16, 17, and 18 highs. But I don't think gold is going to go down much lower than this support point right here around the 1300 area. So selling puts out of the bull put spreads out of the money here with gold makes some sense to me right now. Okay. And then, of course, if we look at silver, silver is the same thing. If we look at silver futures, it had a false breakout. Look at this in this triangle here. It's a symmetrical triangle. And you can see here on this symmetrical triangle, we've just been winding up for a long period of time. And every breakout, as you can see here, we've only had a few going all the way back to 2016, the summer of 2016. We've only had a few breakouts, both to the upside and to the downside. We've moved back inside the triangle again, okay? But we're just winding up. And I do believe when gold starts to make its run, so will silver, and silver will be back up in this area, but now's not the time. We may even break through this triangle and move out and just have a long expanding consolidation period before we begin our journey to the upside with silver. But it's going to be interesting, guys. And then finally, in the energy market, a lot of this, there's already fear premium built in with Trump possibly moving out. He's indicated on May the 11th or May 12th, he's looking at possibly getting out of the Iran deal. Notice here on the screen, I've got a target price of WTI up around almost $72 a barrel. We're floating around the highs right now. There is no divergences, so that would indicate any pullback is going to be purchased or bought. The only issue that I have with oil being up at this high point right now is we're subject to some massive fast swings to the downside, because looking at the commitment of traders report, which basically lays out how all the big money is playing along with commercials and speculative money among them, we're seeing an overcommitment to longs. And anytime you get lopsided to one side of the boat, generally the markets tend to go the other way, because you've got, once the selling starts, you've got a lot of weak hands in there, and you'll see them start to sell early to take profits. That'll beget more selling, which will beget more selling, and it'll drive the price down very fast. So I see a bigger support area in oil around the $63 a barrel. But should Trump get out of the Iran deal, you'll see oil move up to my target around $72 a barrel near term. So that's kind of what I'm seeing right here. And then the other thing that we're playing in the ag market, we're playing in corn. If you can look at corn, we've got a trade on here, and it's working out very nicely for us so far. And we're looking at some other trades in other areas in the commodity market too. All right, everybody, that's pretty much where we're sitting right now for our members. I will see you this Sunday night for our weekly market watch. If you are not a member, I highly encourage you to come in. We're having a lot of fun. But of course, we want to make money, which is what we're doing. So that's always where we're headed here. I think the rest of this year is going to be extremely interesting, and it's going to offer up some great opportunities for us. And it's going to be some surprises in there as well. All right, everybody, have a great weekend. Members, I will see you this Sunday evening. Take care, folks. Ciao.